price opened. Now, what this shows us is that price traveled all the way up to the top of this wick, but it didn't close at the very high. It closed right here, so that's the close. And then you have the high and the low. Now, this example is from a 1 hour chart, but you can use literally any time frame to visualize price action. And all we're doing is visualizing that time range's price action. What was the highest high? What was the low? Where did it open? Where did it close? Now, this is very important because whenever you're bearish, you're going to expect the open and then the high to be made, because if the market's being manipulated, what are we going to see? We're going to see the market jab up before moving down, and then you're going to come up for the close. So whenever you're bearish, you need to understand that whatever time frame you're looking at is likely going to go up first, make the high, and then push down to make the low and the close. This is going to be important for the time and price module later that I'm going to teach you today. Now, also something that is very important for today's teachings is the understanding of a swing high the way that I teach it. Now, a lot of people will have complicated ways of doing this. They'll have a bunch of different highs, and they'll say that, you know, this is the swing high and this is the low. I don't look at it like that. The best way to do it is every single candle that has a lower high on either side. So see right here, this middle candle has a lower high on either side. That makes it a swing high. Now for swing lows, it's vice versa. This candle has a higher low on each side, so that makes it a swing low. It does not have to make new structure or any of these other complicated ways in order for you to use swing lows and swing highs for the way that I teach price action. Now, I want to go back to this example and show you something that I like to call trapped traders. Okay, guys? Trapped traders is going to be a very, very important idea in ICT concepts. So if you look right here, in this example, we understand that the smart money is selling. But every time the smart money is selling, there has to be buyers. So you have to look at it like a lot of people are going long right here. Now, what's going to happen is whenever the market moves against them, they're going to have their stop losses at different places because there's a lot of traders who trade the breakout of every high. Some of you guys watching are probably those traders, but after today, we're going to fix that for good. But these traders are going to have their stops here. They're going to have them here at this low. They're going to have them at this low. They're going to have them all over the place. And you have to understand that when traders are getting stopped out of a long, right? Like if all these traders are in longs, if they're getting stopped out and everybody gets stopped out, that is so much selling pressure, which then causes these aggressive moves like you see here. So understanding where traders are trapped in the market can tell you where the market's likely to go and where it's not likely to return. Because if people were buying above this high, you're very likely to see price not return there. Because if we're smart money, we don't want to see traders get out here for a profit. They are fuel to move price to the downside. So as we've said, liquidity is just the ease at which an asset is bought or sold. So if we have a range, we know there's going to be a lot of buying at the top of it, and there's going to be a lot of selling. Now, whether this is from people getting stopped out on shorts or people trying to buy the breakout, or whether it's people getting stopped out on longs or people trying to sell this breakdown. Now, you have to understand that price is always going to be moving from liquidity pool to the next because price moves to fill orders. It's not because of some random pattern like a bull flag or anything you've learned. So you have to understand that the largest amounts of liquidity build at key levels, and this is how we're going to find our support and resistance. This is how we're going to find where we are going to do business in the market. Now, I want you guys to remember this because this is so powerful, and if you ask yourself what the market's doing at every turn, with this in mind, you're going to be a much better trader. So in a bullish market, you buy from sellers under lows at sell side liquidity. So for example, if you are looking for the market to be bullish, if you come under lows, you're expecting the market to go higher. So you want to be positioned under those lows and be buying from all the people who are selling. Now, in a bearish market, you sell to buyers above highs at buy side liquidity. So for example, once the market comes above highs in a bearish market, you want to see it reverse and you want to be selling with the smart money. This is exactly how the largest market participants operate, so you should too. And if you watch price action and ask yourself, how is price behaving? Are we manipulating highs or are we manipulating lows? You'll be able to have a very clear read on the markets. All right, so now that we've got some of the basics out of the way, let's get into the core concepts of ICT. We're going to start with market structure. Now, market structure is simply highs and lows. Now, the key is knowing which highs and lows to use and having a practical, repeatable method of finding market structure. Now, the reason market structure is important is because it is the foundation of everything else you do. And it's going to be involved in almost every concept that you learn, yet most people do it completely wrong or have complicated ways of doing it that cause them to be paralyzed when it comes time to trade. Now, you've probably seen diagrams like this, right? Like, wouldn't it be easy if the market just moved like this? Now, of course, yes, we understand that market structure is higher highs and higher lows, but we all know it's not that easy.
Elke maand komen er weer dezelfde facturen binnen. Toch moeten die krabbels elke keer opnieuw worden gezet. Maar de inkoper is druk.
Or maybe it is. Now, after years of struggling with market structure and losing trades because I didn't know what I was doing, I realized that the only market structure that was valid was whenever it was accompanied by displacement. Now, if you guys have been watching my channel for any period of time, you've probably heard me say this word a million times, but displacement is just energetic moves. So the idea here is that we're trading with smart money. So if we're trading with smart money, you want to have energetic, big pushes. So for example, does it look like smart money bought right here? No, it looks like smart money sold in this wick. Now, I want you guys to understand that smart money a lot of times is getting active in the wick of candles because it takes a lot of selling pressure to create a wick this large. So if you see something like this through a point of structure or through a swing point, then that is what we call manipulation, and the market is likely to reverse. But if you see displacement, this means that there wasn't any smart money activity selling above this high. And if smart money is not selling at this high, then the market's likely trading up higher. So whenever it comes to structure, just pay attention to what is getting displaced and what is getting manipulated. Now let's look at a price action example. If we look right here, the market comes up above these highs. Now, a lot of people will say, oh, well, it closed a candle body, so it's going to continue. That just doesn't work. I'm going to show you guys some very mechanical ways of how to determine when to expect manipulation or displacement, but for now, let's take a look at this example. So as we can see, the market comes up above it, but we don't create any kind of fair value gap. Now, a fair value gap is one of the core pillars of ICT. All it is when you have an expansive candle like this that leaves a gap between the candle before its wick and the candle after its wick. So we displaced through that low. Now we expect this market to continue and create bearish market structure. And what does it do? It creates a low, creates a high, and then it goes to the next low. Now when you use displacement and manipulation, what you can do is anytime we displace a low, you see that price leg that displaced it, whatever point is made by that price leg is likely to get traded into later, like you see right here. And this will likely continue until you manipulate. And as you can see right here, there's no fair value gap created through this low, and we immediately pop back above it. Now, whenever you manipulate, what you expect is the swing point that failed to displace through this low, which would be whatever swing high was made, which is right there. We expect that to be traded into. Now, if you look over here, this low failed to displace this high, so it was traded back into. Now, when you combine manipulation and displacement, you have even higher probability that the market's likely to continue. And just by looking at this price action, you can see we displace here, what happens? The market continues through this high. We manipulate these lows, what happens? We displace through this high. Now, if you look right here, we push up and displace through that high. So just that next high is the target. But right there, we failed to make a fair value gap. So we then retrace down to the low that failed to push through the high. Now, this is just one example, but I want you guys to test on your charts how often this works, because this is something that changed the way that I looked at the markets forever, and it finally gave me clarity to market structure without trying to map out, all of these big ranges and all these different things. Now, coming back to this example, as you can see right here, this is the same thing we're talking about. We fail to displace, we don't create a fair value gap, and then what happens? We displace through this low, creating these fair value gaps. And then what happens? The market continues down lower. We fail to displace through this high, and then the market displaces lower. And you will see that this is the pattern the market repeats over and over and over again. Next, let's talk about premium and discount. Now, before we get into it, I want you to think of trading like a business, and candles are your product. Let's just say you have candles for sale, meaning you want to sell, you're bearish. Do you want to sell your product for a premium, or would you want to sell it for a discount? The answer is obviously anytime you sell something, you want to sell it for a premium price. You want to sell it for high. And if you want to buy, then you would want to buy for a discount. So let's take a look through this example. The market displaced down through this low, and it created a fair value gap right here. So if we're looking for an area of where the market's likely to go back up into before it moves down lower, you can use premium and discount to tell you where that's likely to happen. So if we take this tool right here, you're going to go on TradingView, you go to Fib, and you mark it out. And this is what the settings you want to use. You would want to just have nothing marked except 1, 0, and 0.5, okay? What this does is it draws a midpoint, it draws a line right down the middle of this range, and we look at it like anything above the midpoint is premium and anything below is discount. So if we have displaced through a low, we know the market's likely going to continue down lower. And when we watch the market, we want to say, okay, well, if I want to sell this market, I want to sell it from a fair value gap in a premium. And then you can see that the market comes up into this area before it continues down to the downside. Now, whenever you create a new leg in price, you want to check, did we displace? Now, in this example, you see right, this is the same thing we're talking about. We fail to displace, we don't create a fair value gap, and then what happens? We displace through this low, creating these fair value gaps. And then what happens? The market continues down lower. We fail to displace through this high, and then the market displaces lower. And you will see that this is the pattern the market repeats over and over and over again. Next, let's talk about premium and discount. Now, before we get into it, I want you to think of trading like a business, and candles are your product. Let's just say you have candles for sale, meaning you want to sell, you're bearish. Do you want to sell your product for a premium or would you want to sell it for a discount? The answer is obviously anytime you sell something, you want to sell it for a premium price. You want to sell it for high. And if you want to buy, then you would want to buy for a discount. So let's take a look through this example. The market displaced down through this low and it created a fair value gap right here. So if we're looking for an area of where the market's likely to go back up into before it moves down lower, you can use premium and discount to tell you where that's likely to happen. So if we take this tool right here, you're going to go on TradingView, you go to Fib and you mark it out. And this is what the settings you want to use. You would want to just have nothing marked except 1, 0, and 0.5. Okay. What this does is it draws a midpoint. It draws a line right down the middle of this range. And we look at it like anything above the midpoint is premium and anything below is discount. So if we have displaced through a low, we know the market's likely going to continue down lower. And when we watch the market, we want to say, okay, well, if I want to sell this market, I want to sell it from a fair value gap in a premium. And then you can see that the market comes up into this area before it continues down to the downside. Now, whenever you create a new leg in price, you want to check, did we displace? Now, in this example, you see right here, we displaced by creating this fair value gap right here. So if you took your fib tool, you'd want to draw it from the new high all the way down to the bottom of the displacement. Now, you just want to draw it from one swing point down to the next. And if you look right here, we then have another fair value gap in premium. And as you can see, we have another fair value gap up here in premium, and we have one right here. So in this example, we look at the market like it's likely to go back up into premium into these fair value gaps. Now I'm going to show you how to execute trades towards these levels, away from these levels, how to know which fair value gap to choose, and much more. But for now, I want you to understand the idea of premium and discount whenever we're talking about market structure. So when you look for reversals, you're looking for them to likely happen in premium or in discount, depending on if you're bullish or bearish on the previous price leg. Now, on a higher time frame, you're usually going to get a very straight move like we just showed with impulses. But if you go to a lower time frame, there's going to be a lot of different structure in between. On the lower time frame, you can get an earlier read of when this higher time frame leg is going to continue. For example, let's go on this chart and take a look at what price looked like in this price leg. So as we can see, we came up into this premium and the market is now in that fair value gap. So once you see the lower time frames start to shift and they also start to manipulate highs and displace lows, that means they're aligned with that higher time frame. And this is where you look to trade and look for all the other ICT patterns. Now, there are numerous ways you can know exactly where the market's likely to reverse, exactly where to trade, where to put your stop loss. And not only that, what time the market's likely to do this. Now, we're going to tie everything I teach you today into a full strategy of how to put all this together. But for now, I want you guys to focus on these basic concepts. Now, whenever it comes to which time frames you pair together, it's very important that you follow time frame alignment. So if you look over here to the left, I have put together a list of what you would use as the higher time frame on the left and then the lower time frame on the right. That example we just used was a 15-minute chart and a 1-minute chart to confirm that that 15-minute leg was likely to move to the downside. Now, whenever it comes to these time frame pairings, you're going to use this for any higher time frame to lower time frame strategy that you learned today. Now, market structure is great and it tells you where price is likely to move. However, It does not tell you why or when. And these two components are very, very important to making sure that you trade consistently, because knowing where the market's going to go doesn't pay you. Executing on it is what actually matters. Now, we talked about earlier with liquidity, it's just where people are putting their stop losses. So every time you look at a chart, you need to be thinking about that. Where are the obvious areas of stop losses? Now, some examples of this are going to be highs and lows, like we talked about, but also trend lines, chart patterns, and psychological levels like round numbers. For example, Bitcoin at 100,000. Everybody wanted to buy Bitcoin above 100K, meaning there's a lot of liquidity there. So the smart money offloaded their positions and dumped on everybody. Now, when you look at this example, you can see that there's trend lines. And then also if you have equal highs, those are very high value areas of liquidity because a lot more people are going to be positioned there. So anytime there is a smooth edge on the chart, meaning you can draw a line from a bunch of highs or a bunch of lows, then you know that the market is likely to trade to that level before continuing on the real move. So I want you to take a look at this chart and tell me what you see. If you've been paying attention this far, you'll notice that we have a lot of liquidity built up on both sides of the market. Now, you might think, oh, well, we swept liquidity here and we're likely to reverse and go to these equal highs.
Kopieer mijn trades, zodat je direct vanaf dag 1 kunt gaan verdienen met het traden. De toepassing van dit concept is traden en er is echt niks magischer dan jouw...
But you're wrong. Why is that? Well, if you look right here, did we have any displacement to the upside? Now, the answer is no. The only time we interacted with the high, we failed to displace. So the market's likely to continue down lower. But we do understand that, yes, there is a lot of liquidity up at these areas. So if you were on the lower time frames and you saw signs of a reversal down here, you could have taken a trade up to this level. Now, this may seem like a lot right now, but as we go through today, all of this is going to come together and you're going to be trading this like a pro. Now, whenever you find areas of liquidity, whether it's the relatively equal highs or trend lines, whatever it may be, you always want to ask yourself, how is price reacting to these levels? And that's going to tell you everything you need to know. Now, let's tie in a few of these concepts together so you know which way the market's likely to go when you look at the charts. As we see right here, we manipulated this high and then displaced a low. Now, what we've created is a range here and we have a fair value gap. A fair value gap is what we're going to call internal range liquidity. So any levels that are going to be inside of a range in price between a swing high and a swing low is going to be internal range liquidity. Now, you need to understand that the market is always going to move from internal range liquidity to external range liquidity. Now, external range liquidity is just highs and lows. So if we look at this example, what does the market do? Well, the market trades into this internal range liquidity and then continues down lower. And as you can see, as the market continuously moves down lower, we keep creating more and more fair value gaps, which show us the market's likely to continue in this direction because we're displacing through lows. And then when the market comes into these fair value gaps, we continue lower. Now, I want you to really understand this concept because once you get the overall direction the market's moving, and the way you're going to do that is by just watching how we react to liquidity pools and then watching what kind of ranges are formed from that with displacement. So for example, let's just say we traded into a level right here. The market then moves away from it and creates internal range liquidity. It's showing you that it wants to expand. Now, I'm going to show you guys how to mark what levels we're expanding to later, but as soon as you understand that the market's moving from one level to the next, then you can look for the market to move from internal range liquidity to external range liquidity until you hit that target. As we can see here, the market had hit up into a key level and then we create fair value gaps. So the market moves from that internal range liquidity back towards external range liquidity. We create more internal range liquidity and when the market trades into it, we go where? Back to whatever external range liquidity was created. This is how the market moves over and over again. Now, I don't know how many of you guys traded retail concepts before you found ICT, but for those of you who didn't, there's a very popular pattern called the bull flag. What this is whenever you have a large move up and then you have this flag or pennant-like formation. Now, these are very, very, very high amounts of liquidity because a lot of retail traders look at this and say, I'm going to wait for the breakout, and we hit right here, I'm going to buy. So think about it. Wherever there is a large amount of buyers, we look for what? Well, as smart traders, we're then going to look for manipulation, okay? So for example, let's say if you see right here, a lot of people are getting into the market because it's a bull flag, right? You might even get some kind of fake out move, but we as smart traders are looking for signs of how you can then capitalize on all that liquidity. So anytime you see the market creating a bull flag, trading into equal highs, trading into highs and failing to displace, and then we displace to the downside, what do you look for? Well, now you have context to say the market's likely moving from internal range liquidity, which is this fair value gap, down lower. Now, where are we likely to move? You guessed it, the low of the range, because the market moves from one area of liquidity to the next. Now, I can't drill this into your guys' heads enough. Now, we're just getting started. I've barely even scratched the surface, but I'm telling you guys, if you can simply understand manipulation, displacement, and fair value gaps, and understand where liquidity is resting, already you're going to be twice as good of a trader as you are right now, because you're going to be able to avoid bad trades and you're going to be able to execute with confidence. And as we can see, the market went down lower. Now, again, we're just scratching the surface, but this stuff is powerful, even though it's basic. But I want to be clear that liquidity isn't everything, okay? It will help you be a better trader than you are right now. And after you see it, you won't be able to unsee it. But without a clear way to use it in a consistent system, it can possibly do more harm than good, because then you start looking at everything like a reversal. And I'm not going to be like most of the ICT gurus and tell you that every single liquidity pool is going to give a reversal, because we all know that's not the case. Now, liquidity can tell us where the market's likely to eventually move. Now, if we have a lot of equal lows, sure, at some point the market's likely going to move down into them. But how would you have known it's not this move, or this move, or this move? Now, this is where ICT traders get stuck, and 90% of them remain on this hamster wheel, never becoming profitable, because they look at every single time we hit a point of liquidity as a reversal. So you have to know exactly where to trade. Now, I like to break down trading into 3 pillars, okay? Where do you trade? Like, what levels do you look at? What do you look for at those levels? And when do you trade? Because if you have those 3 things down, and it's very clear, it's not subjective, and you have a repeatable, clear-cut plan of what to do when you get into the markets, your trading will change overnight, because all these things that you think are, oh, I have psychological issues, I need to go read Trading in the Zone or some psychology book. It's bullshit, dude. You don't have psychology issues. You just don't have a clear-cut way of doing things. So whenever it comes time to trade, you freeze, you paralyze, you hesitate, you overtrade, you do all the shit that keeps you unprofitable. So today I'm going to solve all of that by simplifying all this stuff we're teaching into a system that is going to make more profitable traders than any other single YouTube video on this fucking planet. So this brings us into key levels. Now, this is where we separate precision versus guessing. Now, I want you guys to understand that every high probability trade starts from a key level. There are numerous kinds of key levels that we're going to be using, and without them, you're just guessing. I want to be clear that not all key levels are created equal, okay? Some are going to be tools that we use for targets, some we're going to use for entries, some we're going to use for stop losses, and the way that you use them is extremely important if you want to stay consistent. Now, we're going to simplify this, so don't be overwhelmed, because most of the time, you've already learned too much. Like, there's already too many key levels that you know of, which causes you to look everywhere for a trade, or you hesitate or overthink. But we're going to remove 80% of that fluff and show you exactly what you need to be looking for. So we've already talked about one of the most foundational key levels, which is something that most ICT traders think they understand, but very few actually use correctly. Now, we already talked about fair value gaps just being a gap with this expansive candle, but these can be used from everything from a higher time frame level to trade from, to how you confirm a trade entry, to where you put your stop loss. However, some fair value gaps have a higher probability of continuing than others. And yes, fair value gaps are central to ICT. This is one of the cornerstones of ICT, but blindly using them or anything is a recipe for you to suck at trading. And a lot of people do this. They think, oh, I learned this pattern, I'm going to trade every single fair value gap there is. And then they wonder why they're not profitable, okay? Understand that these levels I teach you literally mean nothing. These mean nothing if you don't have context. So let's break down the different kinds of fair value gaps and how to properly use them to trade profitably. Now, if we look at this example, we can obviously see there's a really big fair value gap, okay? Now, a lot of people see big fair value gaps and think, oh my God, it's the best fair value gap ever. And this can be true sometimes. Let me explain. This fair value gap is very high probability. Now, I want you to take a look at this and think, why this fair value gap? Now, again, most of you are going to say because it's large. However, the reason that this fair value gap is high probability is because it is what we call a break in structure gap, or a BSG. Now, Why are these valuable? Well, if we look, this fair value gap broke through a tremendous amount of structure. We displaced through not just one low, but a lot of lows, okay? So what this tells us is that this market was just rapidly pushing through all these areas where smart money could have had the opportunity to buy. Remember, we look for smart money to buy under lows. And if you don't see smart money doing that, then guess what? The market's likely bearish. Because if the market was bullish, smart money would look at opportunities to buy. However, it's not looking at anything. There are no buyers stepping in, and aggressive selling is in control.
If you're a trader trying to pass your challenge and get funded, we will pass it for you in the next 30 days, guaranteed, or you don't pay a single penny. Now, how can we make such a results-driven claim like that? Well, it's simple. Just look at our track record. Mo managed to get funded and withdraw $6,200 in profit in just 8 trading days. Tom managed to get funded even though he had no prior experience. And Danny got funded and withdrew $3,100 in profit in just...
Now, something else that you have to think about is sometimes retail traders get lucky and are on the right side of smart money. So remember when we talk about lows, what is happening at lows? Most people in ICT always just think it's sell side liquidity because people are getting stopped out on longs. And while that is the case, we also have to remember people are selling the breakout. So there's going to be people selling every one of these lows. And what that's going to create is a lot of liquidity at their entry point. So I'm going to delete this box right here so you can see better. But think of it like this, like a lot of people sold on the break of this low, a lot of people sold on the break of this low right here. So there's going to have been a lot of people entered the market. And if the market moves rapidly in their direction, what are they going to do? What do retail traders do too early when the market moves in their direction? Well, traders who are unprofitable oftentimes move their stops up to their entry. Now, what has this just created? This just created a lot of liquidity at these areas. So if you are looking at the market saying that we have a very high probability of continuing because of a break in structure gap, what these points can tell you is where the market's likely going to reverse from in this fair value gap. Now, these points are called inflection points or IP. Now, I made up that term. No, ICT has never said it. He'll probably see this video and say that it's wrong. I don't care. I've learned over the years that ICT stuff is good, but as you'll see today, I don't use 80% of the complicated stuff. I just use stuff that makes sense to me and has helped me over the years. So as we can see in this example, the market will then eventually come back up to these inflection points, okay? It's very, very likely the market's gonna come back up to them, and you can expect the market to give a reaction from them. Now, I want you guys to understand that the market, once it hits into a key level, then you look to see what happens next. So you wouldn't have paid attention to any of this stuff down here because it's just noise, okay? Once we hit into key levels, we're expecting the market to move, then guess what? Then the market creates another fair value gap right here. You could have traded this move down and so forth. Now, I want you guys to pay attention to something else that you may not have seen on the first go around. Right here, what happens from this area right here? Boom. We hit into that inflection point and move lower. Now, inflection points are great levels that are used later on once price returns to old fair value gaps. However, you don't have to have an inflection point to trade every fair value gap. They're just useful tools that can give you a more pinpoint level of where inside a fair value gap holds the most liquidity. Because the whole idea behind fair value gaps is that there was such an aggressive amount of selling here that we expanded rapidly and there wasn't enough time to offer the other side of the market. So the only thing that was going on here was aggressive selling and the market was rushing to the downside. So when the market moves back up here, especially to inflection points, you can look for signs of a reversal. Now, if you see the market hit into these levels and you go on the lower time frames, right here, what you're likely going to see is that manipulation and displacement. This pattern is going to be something you see all over the place. But the key here is you have to look at it at the right areas, okay? Not just anywhere. If you just try to do this by itself, it's not going to work very well. But as you notice right here, we hit into this and then what? We displace through lows. And then you see the market continue down. I'm telling you guys, once you see this, you won't unsee it and your trading changes forever. Now, let's talk about the next kind of fair value gap. If we see in this example right here, we see a large fair value gap that displaced through this high. Now, disclaimer guys, nothing's 100%. Like I told you, yes, we expect the market to continue through a high if we've displaced. So like right here, we displaced this high. So you'd say, okay, well, this is the target. Now, there's going to be people in the comments saying, oh my God, it doesn't work every time. Of course, nothing works every time, guys. Disclaimer, sorry, there's no 100% win rate Holy Grail strategy. There's your Holy Grail there. But how do we tell when this is likely to fail? Well, if the fair value gap that broke structure gets inverted, or really any fair value gap, when it gets inverted, that tells us that the market is weak, because in a bullish market, we don't want to see these fair value gaps getting inverted. We always look at the market in the sense of really just key levels and confirmation, okay, guys? You'll see this theme repeated through today, but at all times, you're just different ways of finding these two things. No matter if you trade ICT or if you trade some other way of trading, it's all coming down to where you mark key levels or how you do it, which we talked about earlier, which is the where you do business in the market, and then what you want to happen. Now, the confirmation is how you react to fair value gaps, candle bodies, and highs and lows. And we're going to get into all the different confirmation patterns, but this for now is the first one, which is an inverted fair value gap. So if you're inverting a fair value gap, you're going to expect the market to then move to the downside. But you only want to pay attention to these for any kind of execution once you've hit a key level. Now, once we've hit this key level right here, which is a time-based level, and we're going to go into how to mark those later, you would be then watching to see if we invert a fair value gap. Because if you've hit a key level and you have a confirmation, like this inverse fair value gap you see right here, cool. Now that is going to be a high probability that the market's likely going to reverse. Because inverted fair value gaps, or any confirmation pattern that the market's reversing, need to happen at a key level. This is everything, guys. If you just delete this level and you would have seen this, sure, it might work sometimes, but you're just gambling. You have to understand the context of these patterns, or you're no better than someone trading bull flags. Now, let's go into the next kind of key level, which is going to be price delivery. And this is one that gets confused by a lot of people, and I'm going to show you a simple hack that can help you never get this wrong. So price delivery tells us whether the market is targeting highs or lows. Okay, if you're in bullish price delivery, the market is seeking out highs, meaning it's seeking out liquidity above. And vice versa, if you're bearish, it's currently delivering lower. Yeah, very groundbreaking info, right? But this is super powerful because whenever price shifts delivery at a key level, a reversal is likely. Now, price delivery is the foundation for all price levels outside of fair value gaps. Now, I want you to pay attention to how we're reacting to candle bodies. Okay, for price delivery, candle bodies are everything. Right here, we engulf these up close candle bodies. Okay, so we have down close candles engulfing up close candles. We have another up close candle print right here. Down close candles engulf it. Same thing right here, where an up close candle prints, down close candle engulfs it. However, you then hit to a key level, and then what happens? These down close candles get engulfed by a bullish candle. Now, this right here is enough to enter a trade. This is one of my most favorite powerful entry models you can use because it gives you better risk to reward than any of the other key levels. Now, when you pair it with an inverted fair value gap like you have right here, it's extremely powerful and it can give you an early entry to catch better trades. Now, an easy way to learn these is if you want to go back to your charts, you can go to the settings up here. You can turn off the wicks and then just look at the candle bodies. This tells you everything you need to know. And the reason this is powerful is because you want to understand what side of the market is getting trapped. Going back to what we were saying earlier, the volume of most candles is in the body. So if you look at it like this, like if we're going into this level right here, all of the volume of all these sellers is going to be in these bodies. So if we see bullish price momentum close above where the bulk of traders are at, because we understand the bulk gap, or really any fair value gap, when it gets inverted, that tells us that the market is weak. Because in a bullish market, we don't want to see these fair value gaps getting inverted. We always look at the market in the sense of really just key levels and confirmation, okay, guys? You'll see this theme repeated through today, but at all times, you're just different ways of finding these two things. No matter if you trade ICT or if you trade some other way of trading, it's all coming down to where you mark key levels or how you do it, which we talked about earlier, which is the where you do business in the market, and then what you want to happen. Now, the confirmation is how you react to fair value gaps, candle bodies, and highs and lows. And we're going to get into all the different confirmation patterns, but this for now is the first one, which is an inverted fair value gap. So if you're inverting a fair value gap, you're going to expect the market to then move to the downside. But you only want to pay attention to these for any kind of execution once you've hit a key level. Now, once we've hit this key level right here, which is a time-based level, and we're going to go into how to mark those later, you would be then watching to see if we invert a fair value gap. Because if you've hit a key level and you have a confirmation, like this inverse fair value gap you see right here, cool. Now that is going to be a high probability that the market's likely going to reverse, because inverted fair value gaps or any confirmation pattern that the market's reversing need to happen at a key level. This is everything, guys. If you just delete this level and you would have seen this, sure, it might work sometimes, but you're just gambling. You have to understand the context of these patterns, or you're no better than someone trading bull flags. Now, let's go into the next kind of key level, which is going to be price delivery. And this is one that gets confused by a lot of people, and I'm going to show you a simple hack that can help you never get this wrong. So price delivery tells us whether the market is targeting highs or lows. Okay, if you're in bullish price delivery, the market is seeking out highs, meaning it's seeking out liquidity above. And vice versa, if you're bearish, it's currently delivering lower. Yeah, very groundbreaking info, right? But this is super powerful because whenever price shifts delivery at a key level, a reversal is likely. Now, price delivery is the foundation for all price levels outside of fair value gaps. Now, I want you to pay attention to how we're reacting to candle bodies. Okay, for price delivery, candle bodies are everything. Right here, we engulf these up close candle bodies. Okay, so we have down close candles engulfing up close candles. We have another up close candle print right here. Down close candles engulf it. Same thing right here, where an up close candle prints, down close candle engulfs it. However, you then hit to a key level, and then what happens? These down close candles get engulfed by a bullish candle. Now, this right here is enough to enter a trade. This is one of my most favorite powerful entry models you can use because it gives you better risk to reward than any of the other key levels. Now, when you pair it with an inverted fair value gap like you have right here, it's extremely powerful and it can give you an early entry to catch better trades. Now, an easy way to learn these is if you want to go back to your charts, you can go to the settings up here. You can turn off the wicks.
My competitors think I have a 10-person team, but in reality, I'm just one guy with an AI employee. When you're a solo founder, the job titles stack up fast. You're the CEO, the sales team, the project manager, the assistant, the entire engine behind the business. And no matter how many hours you put in, something always slips through the cracks. There just aren't enough hours in the day, and the weight of doing everything makes it hard to move forward. So I gave Motion's AI employees a try.
And then just look at the candle bodies. This tells you everything you need to know. And the reason this is powerful is because you want to understand what side of the market is getting trapped. Going back to what we were saying earlier, the volume of most candles is in the body. So if you look at it like this, like if we're going into this level right here, all of the volume of all these sellers is going to be in these bodies. So if we see bullish price momentum close above where the bulk of traders are at, because we understand the bulk of traders are in the bodies, and we know that we're now closing above them, you could say that these traders are underwater. And then if the market comes back down into them, then we're likely to move away from it because we don't want to let those traders get out for a win. So for example, whenever you're talking about liquidity, you want to see the opposing side of the market off sides or in the red. So if people are selling all through this area and you know that the majority of sellers are positioned at least in these bodies, okay? Yes, there are going to be people up here, but most of them are right here. If the market goes back above them, they're now underwater. And if they get the chance to, they're likely to get out for break even. This is going to create buying pressure because the people who are in sells are exiting, which is the equivalent of a buy. That's why in a bullish market, you will see the market find support on down close candles. And you'll see this pattern repeat itself until the market's bearish. Now, you don't want to pay attention to every single one of these. You mainly want to pay attention to the ones that happen at key levels. Again, guys, key levels and confirmations. Okay, this tells you everything you need to know. And you'll be able to summarize pretty much everything you learn when it comes to analysis into one of these two things. And everything else is noise. And that brings us to one of the most popular ICT concepts, which is an order block. So an order block is created whenever price shifts delivery with force, and it leaves behind a key level. Now, we've already just explained why order blocks work, so I won't spend a ton of time on them, but really you need to understand that in a bearish market, up close candles are going to be used as resistance, and you can look to trade from them. Now, you always want to pay attention to ones that hit into a key level because, as with anything, again, the stuff you see happen at key levels is what's important. You don't want to pay attention to every single order block or every single fair value gap if you want to be profitable. Now, some tricks with order blocks is that they must be followed with displacement. The highest probability ones are going to create fair value gaps as price moves away from them. Now, to be clear, not all order blocks are created equal. And after watching thousands and thousands of candles print, I came up with a much better way to pick which order blocks you're going to trade from. Now, I've taught you guys a ton of different key levels. And if you've been trading for any period of time that you understand, not all key levels work. And I've told you guys that. So How do we understand and determine which liquidity actually matters, or which levels actually matter, and which is just noise? Now, price is going to be subjective, meaning that whenever people look at the markets, you and I might see them in a different way, and there's no factual way to say who is right or wrong. However, there is one filter that we have access to as traders that is fully mechanical, and this was the biggest breakthrough in my trading career, and that is time-based liquidity. Okay, most of you who have been struggling with ICT, or those of you who are new and learning this, you're probably wondering, how do we know which highs and lows to pick? How do we know where I should sell, where I should buy? And this was me for so many years. I would understand these concepts, and I just couldn't figure out which levels and which lows and which highs, and it was so taunting because I knew there was something here, but I didn't understand how to filter out the nonsense and how to be able to take the high probability trades. So you might feel like, oh, well, it's random which highs and lows we move from, but that is not the case. The market is not random, and time plays a bigger role than you realize. Now, this is something that gets put around the ICT community, and people try to be all mysterious about it and act like it's some enigmatic thing. I'm going to simplify it for you guys so you can eliminate all the noise. But I want you guys to understand, first and foremost, that every big move in the markets, every single one, happens around time-based liquidity. Now, there are patterns that repeat across the week, across the day, across the session, and this reveals where the highest amount of liquidity sits, and it helps you have a mechanical way of picking highs and lows and fair value gaps and every other level that you will learn here today. But before we get into time-based liquidity, I want to teach you guys something called SMT divergence. So really simple stuff, guys. Whenever you have markets that are correlated, so for example, if we have NASDAQ, which is what I've been showing you this whole time, NASDAQ is correlated with ES, okay, and YM. Now, this is the S&P 500. This is the Dow Jones Index. So the stock market usually moves together. The different indices move together. So let's just say we have NASDAQ here on the left and ES on the right. Now, what you're expecting is these markets, if one of them is making higher highs and higher lows, you're expecting the other one to do it too. However, if you see one of them make a lower low while the other is making higher lows, that is going to be a divergence, meaning there is difference at the lows. Now, anything you see where the lows are being messed with, we know is bullish because smart money manipulates lows to buy. So in this example right here, we notice there's a higher low right here on the NASDAQ. However, there's a lower low on ES. Now, what does this mean? Well, this means that this move lower is likely just a manipulation in order for smart money to get positioned. And if smart money is getting positioned on the lows, that means we're likely to go higher, okay? This is a pattern you'll see repeat itself time and time again, and it can be used as a complement to the other concepts we use. For example, if you come into the market and you see something like this happening, then you know the market's likely to be bullish. Now, another example of this is, let's just say you're trading a Forex currency like the euro dollar, and it is making a higher high. Well, if you're looking at the dollar on the left, what you would expect is it to make a lower low because they move inversely. However, if there's a break in that correlation, that is SMT divergence in its own, and that signals that a large move is likely to take place. I want to be clear that the key isn't just spotting SMT divergence, it's knowing exactly where and lower low the session is correlated with ES, okay, and YM. Now, this is the S&P 500. This is the Dow Jones Index. So the stock market usually moves together. The different indices move together. So let's just say we have NASDAQ here on the left and ES on the right. Now, what you're expecting is these markets, if one of them is making higher highs and higher lows, you're expecting the other one to do it too. However, if you see one of them make a lower low while the other is making higher lows, that is going to be a divergence, meaning there is difference at the lows. Now, anything you see where the lows are being messed with, we know is bullish because smart money manipulates lows to buy. So in this example right here, we notice there's a higher low right here on the NASDAQ. However, there's a lower low on ES. Now, what does this mean? Well, this means that this move lower is likely just a manipulation in order for smart money to get positioned. And if smart money is getting positioned on the lows, that means we're likely to go higher, okay? This is a pattern you'll see repeat itself time and time again, and it can be used as a complement to the other concepts we use. For example, if you come into the market and you see something like this happening, then you know the market's likely to be bullish. Now, another example of this is, let's just say you're trading a Forex currency like the euro dollar, and it is making a higher high. Well, if you're looking at the dollar on the left, what you would expect is it to make a lower low because they move inversely. However, if there's a break in that correlation, that is SMT divergence in its own, and that signals that a large move is likely to take place. I want to be clear that the key isn't just spotting SMT divergence, it's knowing exactly where and when it matters. And time is going to help you do this with even more precision than price alone. Now, here's another example at the highs. A lot of times people ask me, if I show an example just on the lows, they'll ask for an example on the highs. It's always the same thing, but if you see right here, one chart made a higher high, this was ES, and then on NASDAQ, we made a lower high. This, paired with other concepts, can be used as a confluence that the market is likely to trade down. Now, there is a lot of people that'll say that one is better to trade. Like some people say the one that made a lower high is weaker. Some people say the one that made a higher high, that's manipulation. You know, the way I look at it, it really doesn't matter. In my opinion, I just trade whichever one has the better setup. Usually for me, it's NASDAQ. All right, guys, so if you want a cheat sheet for different correlated markets, I'm not going to read every single one of them out, but you can pause this, take a picture of your phone, take a screenshot, whatever. These are the different markets that should move together. And then here are the markets that are inversely correlated. This is what I was talking about, like with the euro dollar versus DXY, which is the US dollar. If you ever want to look at the US dollar on a chart, you would type in DXY. You could use it versus gold. Another thing you can use is bonds versus equities. But anyways, I'll let you screenshot this and you can use this as a cheat sheet. All right, next, I want to teach you guys one of the cornerstones of ICT and how to trade different price legs. So this is called a market maker model. You've probably seen this before. It gets overcomplicated all the time. All this is a strategy to visualize retracements and expansions on a lower time frame. All right, guys, it's not that complicated. People make it out like they have all these big words. If you ever want to look at the US dollar on a big words, I didn't draw this. Like, I don't come up with these names: distribution, redistribution, SMR. Like, next, I want to teach you guys one of the cornerstones of ICT and how to trade different price legs. So this is called a market maker model. You've probably seen this before. It gets overcomplicated all the time. All this is a strategy to visualize retracements and expansions on a lower time frame. All right, guys, it's not that complicated. People make it out like they have all these big words. I didn't draw this. Like, I don't come up with these names: distribution, redistribution, SMR. Like, you don't need any of that, okay? All you need to understand is what side of the curve we're on, okay? Like, if we hit a higher time frame key level, on a lower time frame, you're just looking for a reversal from it. It's one of the most overcomplicated things, but I want to teach it to you, not even because you need to understand market maker models. It's more so to simplify, because a lot of the stuff you've learned is just overcomplicated. All it is once you hit a higher time frame key level, on the lower time frame, you're going to have consolidations on the way down to it. There's going to be liquidity at these areas, and there's going to be some original consolidation where that higher time frame originally started reversing from. And really, the power in this is it helps you avoid overtrading and hold good trades longer, because, you know, if you're expecting the market to move all the way up here, what it does is it shows that once you hit one key level, okay, you look for this entry pattern, and once you've got your change of the state of delivery, maybe there's an inverse fair value gap, maybe there is a fair value gap and a displacement, whatever it is. All this says is, like, once you traded from one key level, you're identifying that you're moving to the next. Now, I'm going to show you how to use time-based levels to be able to filter out a lot of the noise, because a lot of people get confused marking the key levels. And if you do that, you're done from the start. But once you have a simple way to do that and you see this confirmation, anytime the market moves in your direction, people will then FOMO and they'll wait. They'll get in a long up here, and as soon as we get a down move, they get scared. When really, this is where you should be either adding to your trade or trailing your stop loss. So for example, let's say you're getting a trade down here. If you see this pattern, like you're in a long and it moves up, you see a consolidation and it jabs under it and then displaces up, like what that's telling you is that, again, like we talked about from the beginning of the video, the way we react to lows and highs tells you everything you need to know. In this example, we manipulated the low and moved higher. This shows us that we're bullish. Now, if the market moved down and then pushed through this high, that's an area where you can put your stop loss, okay? Because the market has now swept liquidity and it's moving higher. And you'll see this pattern repeat again and again. Now, one of the ways that you can look for market maker models is whenever you trade into a fair value gap. So in this example, we trade into the fair value gap right here. And on the lower time frame, this wick was a market maker model. And this is going to be how you execute on these moves from internal range liquidity to external range liquidity. So this is the exact same fair value gap right here. The chart I just showed you is the weekly, and this is what it looked like on the 4 hour. So I want you guys to use the same alignment that I told you earlier in the video whenever it comes to IRL on the left, and then looking for the market maker model on the right. So if we look right here, the market hit into that weekly fair value gap, so this is going to be a 4-hour chart.
Invest in your preferred currency with eToro, US dollars, euros, or pounds. And skip conversion fees when investing in local stocks. eToro. Join now.
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 44, a complete AI creation platform. Describe what you want, and watch it take shape. You can plan, customize, and expand in any direction. From tools built for one, to platforms ready for many. From passion projects to enterprise-grade systems. Everything is built in and ready to launch. It's a new world of creation, where you can go as far as your imagination takes you. Can you imagine it? Let's make your dream a reality, right now.
Now, what we're looking for is the market to hit into that fair value gap after we've swept a low, and then we want to get some kind of confirmation. Again, key levels and confirmation, guys. Notice right here, we get that change in the state of delivery. As soon as this happens, remember, we're expecting these down close candles to act as support, and you could look to execute trades from this. And as we see, the market trades down into it and then moves higher. And anytime the market does this from internal range liquidity, we know it's likely to go to that external range liquidity. So again, in this higher time frame, all it looked like was this. The market traded into that internal range liquidity. You go on a lower time frame, find the market maker model, and then you know the market's likely to move to external range liquidity. Now, the reason we were looking for this in the first place is because the market was displacing highs. So we expect the market to move higher. Now, you could take this even a step further because as you notice, there's fair value gaps in this move. And once you identify that you're on the buy side of the curve, meaning you're moving up. And where do you identify that? Well, as soon as you get this change in the state of delivery. So anything to the right of this, you would look at if we're hitting a low or if we're hitting any kind of support level, you could look for the lower time frame for what? If you guessed another market maker model, you're right. So let's take a look at this wick on the next time frame down. Now, for this example, we started on the weekly, then we went to the 4-hour. So if we start on the 4-hour, we're then going to go to the 15-minute. So this is that wick that traded into that 4-hour fair value gap. And what do you see? You see a displacement, you have a change in the state of delivery, and notice how these down close candles act as support. So when everything's aligned, you can only look at one side of the market and have confidence. Now, as soon as you got this change in the state of delivery, look at that as a line in the sand. Everything to the right, you now can expect those key levels to work. And as we see, this order block worked. This is how you're going to be able to trade with a lot of confidence. Now, in the other example, this was the external range liquidity. So if you take a look right here, we had internal, which was this low. So where's the external? It's right there. And that is what I have marked out right here. So you can just break down price action on lower time frames and get a different view, but it's really all the same thing. The market's always moving from internal range liquidity to external. But when you have multiple time frames aligned, that is when you can have confidence that your key levels like order blocks and fair value gaps are likely to work. Now, we've went over liquidity, we've went over market structure, and you have a decent idea of how price moves. But the most important question is, do you know when? And this is the most important part of everything that you will learn when it comes to ICT. And I remember like yesterday, it literally gives me chills thinking about this. All the mistakes I made. I mean, I learned this for years and I didn't have anybody to help tell me this. I had to figure this out on my own after losing a ton of money, and I almost gave up on ICT. I almost thought this stuff doesn't work. It's bullshit. I thought all those things. But then once I realized that there was such a simple thing hidden under my nose the whole time that fixed all the mistakes that I made, once I figured out this one thing, this is when my trading finally took a turn and I became profitable. And let me tell you guys, when you become a profitable trader, it's not like any other business. Like any other business, it's kind of like you have this gradual come up. Usually trading is like you get lucky, you go through a really deep, dark time, you think about quitting. And this is where a lot of you guys are at right now, okay? This is where a lot of you guys are at, and it's okay. You're not alone. I was in the exact same boat. I almost gave it up multiple times. I took breaks from trading even. But once you finally become profitable, it is the biggest bull market you've ever seen, because once you have this skill, once you can filter out what is likely to happen and what isn't, and you have confidence, your entire life changes overnight. Now, to be clear, before we break this down, if you can't execute it daily, then it doesn't matter. So in the study guide, if you downloaded it, if you didn't download it, go and download it, and shame on you for not taking this seriously. But in the study guide, you will see in the resource library a trading plan, because yes, there's a study guide, there's a resource library, there's a free community, there's all that stuff that's going to help you become profitable. But in the trading plan, it gives you a very systematic process, how to mark out key levels, and we're going to get into how to plan scenarios. Now, a big mistake ICT traders make is they always want to talk about bias. They always want to talk about daily bias, and we're going to get into why not to use daily bias later. But for now, I want to give you guys some words of reassurance, okay? Because you have to understand, like, all this stuff I've taught you today, it's all great. It can make you money, all this, yes. But if you don't have a system, then it's just random. You're just gambling, okay? This is where most traders get stuck forever. Most traders, they learn the concepts and they know all these different things, but when they sit down and it's time to make money, they hesitate, they overthink, they freeze, or even worse, they just start taking random trades. So what I want to teach you now, guys, people might say it's boring, but let me be clear. When trading becomes boring, that is when you know you've made it. Because if it's exciting, you're gambling, okay? Now, all of us get into trading because we like gambling. Let's be honest. We're all gamblers at heart, but you have to be able to be a controlled gambler, and it shouldn't be excited anymore. You shouldn't be all hyped up. Trading should become very, very, very boring. And it is boring. I get more joy out of doing this right here, what I'm doing right now, talking to a camera, talking to you guys, than I do trading ever. It doesn't matter how much money I make or how much money I lose, because it's all the same after a while. But I know that if I can give you guys something that can help you guys get further along than what I had whenever I was in your position, that's giving me more excitement and joy than trading ever will be able to again. Because now, after I've systematized it, it's numb. I want to be clear that this is what makes the difference between someone who knows how the market works and someone who actually profits from it. Yes, those are two different things. This is why you see people who are these Twitter analysts who can draw out the chart and call where it's going, but you never see them post a blip of profit. You don't even see anything that proves they're actually making money. Now, to be clear, there are two things you need to become a profitable trader. That is a standard operating procedure that removes emotion and makes trading repeatable. Because no matter how much you know, if you don't have rules that are set out for you, when you get to your desk, there will be an emotional filter on things. You come into the market, you see traders trading daily bias, and they come into the market ignoring half the information that's there. Now, you also need a mechanical strategy that gives you clarity on exactly when, where, and what you need in order to execute and exit trades. So the difference between these two, because I get a lot of questions about this, the SOP is everything outside of entry, okay? Like, how do you go about your morning routine? How do you journal your trades? How do you manage risk? How do you go at prop firm challenges? All of these things. This is what really matters, and nobody talks about online. Everybody just wants to draw chart patterns because that's what people like. I mean, I see it in my retention graphs, but I didn't make this whole project as a retention thing. As you can see, I don't even know how long we've been going now, but I made this to make profitable traders. So if this kind of stuff bores you, then we probably won't get along, because I'm in the business of being a professional and I want to work with professionals. But this is the process that builds consistency before and after you touch the chart. This is pre-trade, post-trade, how you mark your levels, confirmation filters, how you're going to risk, your stop loss rules, all of this. And this is what really removes emotion and hesitation, because you can have your trading strategy, and if you don't have this, then you can still be in a
doen is je daily profit eruit halen. Dat is gewoon wat je moet halen sowieso. En de rest op break-even zetten. Ja.
Emotional wreck with a strategy. Because all a trading strategy really does is it helps you execute mechanically. It's your entry model, what makes you pull the trigger.
Traden zonder je eigen geld te gebruiken? Ja, dat hoor je goed. Er is nog een onbekende manier van traden waarmee je met geld van anderen kan handelen. En voordat je deze video wegklikt, je hoeft hier niet jaren voor te traden. En ook als je verlies maakt, hoef je het ook niet terug te betalen. Het traden met geld van anderen heeft als voordeel dat je...
Now, once this is locked in, you're not really just analyzing the markets anymore. Like, sure, everything you've learned today comes together and you have an awareness of it, but you're not going to look at every single level on the chart because you're not trying to catch every single move. You're trying to have a system that makes you money in the long term. You don't want to be guessing around or just like drawing lines on a chart because that gets you what I like to call decision fatigue. And this is where most ICT traders get stuck forever. And you might be here right now. Chances are you are. And I was here for years because you learn all these different concepts and you see that they work and then you don't know when to actually use them and when not to. So having a system is very important because it tells you exactly what to do. So my pre-trade process is pretty simple. Now this is in the Notion you got with the study guide, but basically, I like to start 30 minutes before the market opens and mark out key levels, understand different conditions, like are we going to expand? Are we likely to consolidate? This way I know what I'm going to be risking for the day, and we'll get to that in the risk management session. But I also like to check for major news or earnings. You could go to forexfactory.com and do this. Now, Forex Factory is a website. It looks like this. You could turn it on, and what you would do is you basically go into the filters, and you would pick any of the markets you're trading. If you're just trading futures, you would just have USD checked. If you're trading Forex, you could pick whichever pairs. Personally, I just turn on the red folder. I don't pay attention to anything else. And a lot of traders will tell you to stay away from this. They'll say, don't ever trade red folder news. It's the stupidest piece of advice. Like, obviously, don't trade right before CPI or something. Don't be a freaking idiot. But I want to have red folder news on the days that I'm trading because I know that those days are likely to be more expansive. If there's no red folder news, I'm likely going to go in and risk less because I know these markets are likely to be chopping around. And it's not to say anything is absolute. Like, you can have boring days on a red folder news day. You can have expansive days when there's no news. But it does give you a little bit of a filter. So you need to always look at this every day before you trade. And if you're trading prop firms, you need to know this because some of them you could fail your challenge if you're trading with the news. You also need to make sure you're not in a trade right before the news happens because you can get slipped. Now, when I say getting slipped, I'm going to show you what I mean. Let's just say you entered a trade right here and you put your stops at this high, okay? And let's just say the market gives you a big, nice FU candle, massively pushes past your stop. Well, if this candle moves too fast through your stop, then you might actually lose more than you plan to lose. This is more likely to happen during red folder news events because what happens is there's less liquidity because smart traders, they're kind of sitting back waiting for it to settle down. And that means that there might not be somebody to fill your order. So the market could expand through it and you lose way more than you were planning to lose. So that's why you don't want to be in a trade right before red folder news. Now, I want to be clear that not all red folder news is created equal. For example, if you have something like consumer sentiment, it's different than if you have the Federal Reserve Chairman, Jerome Powell, speaking. Okay, the big ones you want to watch out for are NFP, CPI, which is inflation, FOMC, which is basically the interest rates coming out, and not just any FOMC. You want to make sure it's not the minutes. The minutes don't really matter as much. Sometimes they can, but I don't really pay attention to those. It's the interest rates, okay? The federal funding rates. Whenever you get federal funding rates coming out, those are the ones that you want to really pay attention to. So for example, this one right here, you'll have a lot of news events. It's always at 2 p.m. These are like the most important news drivers in the markets because this is how everything else in the economy is read by smart money. Now, a couple tips. If you see the forecast, right, like this is what economists are planning is going to happen. You're not going to have the actual until after the news comes out. But for interest rates, if the actual is the same or lower than the forecast, that is bullish. If it comes out higher, then it's extremely bearish. Now, the reason for this is basically this is the Fed's way of setting the price of money. Now, I know that may sound crazy, but essentially this is basically the rates at which the biggest banks can take loans at. And I'm not going to get into that. Somebody will probably correct me in the comments, but if you guys want to learn macroeconomics, go get a book or something. Now, inflation is another thing that is very, very impactful in the market. So when we have inflation, it's going to be CPI. The one you really pay attention to is this year over year. I mean, they're all important, but for example, notice how right here, the CPI was lower than expected. Now, what this means, if you see red on here, this can be confusing because this means bearish for the dollar. But if it's bearish for the dollar and stock markets move inverse to the dollar, then that means it's bullish for the stock markets. Now, this isn't foolproof, it's not 100%, but usually inflation going down lower means that the markets are likely to be more bullish. Now, the news is just one way you're going to identify the session narrative. I'm going to show you some other ways as well, but it's really important that you go in and have an idea of your surroundings. Now, next, we're going to be building out scenarios. Now, I want you to be very, very, very careful that you never get stuck in a bias. A lot of ICT traders and ICT himself will tell you like daily bias. And it's just this stupid term that makes so many people unprofitable. Basically, it's saying which way is the daily candle going to close. Like if you're trading the 1 minute, which most of you guys are trading the 1 or 5 minute, if you're trading prop firms, you don't need to know that, okay? You just need to understand how to have a system that gives you key levels and plot reactions from them, okay? So I want to be very clear, guys. Don't roll out of bed and try to trade right when you wake up or something or rubbing your eyes. You're not being a professional at that point. If your brain isn't ready, your trades won't be either. So I always like to say, if I don't get good sleep, if I don't follow my morning routine, then I don't trade. Now, look, I'm not saying you have to wake up and go run a fucking mile or get in the cold plunge or be David Goggins. I mean, just wake up a little early, have a little bit of mindfulness practice without your phone. Like I just like to write down what I'm grateful for, meditate a little bit, get ready for the day. You don't have to, I'm not saying you have to fucking run a marathon or something, okay? But it needs to be intentional. And the reason is because you're basically forming the identity of a professional. You're saying, I'm taking this serious. You're putting yourself in the right state of mind to succeed. Now, I know I've shown you guys a lot of different levels. And in the study guide and the resources, you will see these sets of levels. Now, I want to be clear. This is all you need to mark, okay? These are going to be all the levels that you actually pay attention to on the higher time frame. And we don't need a bias other than that. And we're going to use the different concepts that I've taught you on the lower time frames to confirm if we're moving away from these levels. So you need to go through your charts every morning and mark out all of these levels. And these are going to be areas we look at the market as our where to trade. Now I'm going to break this down on a chart in a second, but for now, go ahead and make sure if you didn't already, download the study guide or just take a screenshot of this so you have these levels on something where you can save it for later. So for example, it's Saturday when I'm recording this, but let's just say you're coming into the market and you need to mark out all these levels. So what you could do is go to the weekly chart first. And what you're going to want to do is mark out the high and mark out the low. Now, me personally, I like having these color coded. If you go on a trading view, you can set templates. So like if you go to this setting after you select a level, pick templates. Now, I already have mine set up where it's just a different color for the weekly daily level. What you would do is like, let's just say if you wanted to have weekly, okay? You would type it in here after you double click a line or any other box you've drawn on TradingView, and you would click template and save as. Now,
does this sound familiar? You read about the cursor hype on Twitter, went to give it a try, seemed to work really well on small projects and things you were bootstrapping, 0 to 1 stuff at the weekend, but when you tried it on some real work, it started to struggle. Let's take a look. I'll jump into Cursor and ask a question about this 20,000 file codebase I have here, a task I'm trying to complete. The default mode for chat doesn't include the whole codebase, so let's try again. I will ask the whole codebase. And Cursor will take some time to look at its index. This is actually a 10-minute old index, and there's some off-the-shelf RAG components being used to power this. And what we see a lot of the time is that this just plucks out parts of the codebase that aren't relevant at all. So it's finding some data structures here.
Now, for the weekly and daily levels, I just have them as purple. That way when
Okay, guys, I'm logging off. Yeah, learned a lot today. I'm gonna upload this one. Have a good day, and see you tomorrow. Cheers.